Okay, thanks everyone for your time this evening. Patrick Hennessy from Bantax Financial Solutions and myself from Bantax in Brisbane would like to present to you your superannuation statement. What is it saying to you? It's trying to talk to you, and what does it really mean? So just to start off, I just want to say a little bit about myself, just half a second or so. I'm from Bantax Brisbane office, and I also operate under Innate Business Advisory, specialising in businesses and Xero and also investment property owners. And I've got over 30 years experience in business, accounting, advisory and tax, and I really like helping people understand their finances and taxes better. And introducing Pat from Bantax Financial Solutions. Pat, would you like to give people just a little bit update on what you're about?
Sure, thanks Colleen. My name's Pat Hennessy. Yes, I'm a senior financial planner with Bantax Financial Solutions. So Bantax Financial Solutions is a financial planning arm of Bantax. We have no allegiance to any provider, insurance, superannuation or investment provider, and we provide a full range of wealth advice. Today we'll be specialising obviously in the superannuation and some aspects of insurance inside super. I am authorised by ASIC, the government regulator, to give advice in these areas amongst other things. So what we do is try to help people to understand their super statements and to point them in the right directions and hopefully save them some money. In many cases we've been able to do that by restructuring the investments inside super, perhaps putting some of the insurance outside super. So there's a number of ways that we can come at that, and quite happy to look at that for people. Thanks, Colleen.
Okay, and with the usual financial presentations, there's a disclaimer. This is general advice that Pat will be giving you, not personalised financial advice catering to your own particular needs. But Pat would be very happy to talk to you after the webinar or after the webinar series, and we'll give you contact details after the webinar. So in this 7-part series, we're covering industry funds and retail funds in a general sense. We're not doing self-managed super funds because it's a whole other ball game and it's very complicated and specific, and it's got lots of legislation. So we're not covering self-managed super funds. And also a note that laws may change, especially tax and superannuation laws, particularly the way the government seems to change at every federal budget. So please seek advice before making any important financial or tax decisions. And we're required to say that under our insurance that liability is limited by a scheme approved under professional standards legislation. So at Bantax, why we care about our clients' super funds. Pat and I have been talking, and we know within the whole Bantax group from Townsville to Adelaide that too many people don't understand exactly what this statement means. And too many people are losing money and losing money unnecessarily. I mean, you can't help it when the whole share market goes down, but you can look at some things which may be costing you money in the meantime, and Pat will be going through these. And many don't understand how small differences now can build up your super balance over time. And not everyone is using the tax laws to their family's advantage with super. And we realise that can be complicated, but we're going to touch on that in the 7-part series. And some people have multiple funds or high fees or don't have the right insurance. And all those things are really important to look at, as Pat will show you. And as we've said, the government keeps changing the rules and it's hard for people to keep up. But the trouble is that if you don't keep up, your piggy bank may disappear. So don't let your superannuation savings fade away. So this is what we're covering in the next few weeks. So tonight is just really a statement overview. Pat's going to show us a typical, in a sense, superannuation statement without names, obviously, and go through various parts of that statement. And then we'll be looking in greater detail at some of those things. So week 2 is your own super. Is it a jigsaw puzzle? Do you have more than one fund, etc.? And then in week 3, big bad fees. How much is too much? Week 4, super performance. Is it really a super performance? Week 5, if the worst happens, insurance and super. And week 6, my favourite part, week 6 is the tax acts into and out of super. And week 7, we're going to just touch lightly on estate planning and super and review the 7 weeks. So we've got a busy schedule in front of us, and we hope that the whole series will be useful to you. So Pat, over to you with life expectancy info then and now.
Thanks, Colleen. Well, this slide here can tell you why I think superannuation savings are so important. Life expectancy is certainly growing. And if you can have a look at this, a person aged 65 now has a life expectancy of 87 or more than 87 years. At the moment, the average life expectancy for a female, I think, is about 83, and a male is 82 or getting towards 83. The males are catching up. But the message from this slide here is certainly that retirement is going to be longer than probably we anticipate. So in this case here, someone who's already 65 can expect to live to 87. If it doesn't show it here, but if somebody is 70, then their life expectancy is going to be pretty close to 90. So we're retired for a long time and we have to make preparations. And the question is, of course, will your super last the distance? So that's why we're running these sessions, to give you an idea of what's going to be required so that you have a reasonable sort of retirement. Okay, the cost of retirement in 2018, the Association of Superannuation Funds Australia calculated that a comfortable retirement for a single person requires a lump sum at retirement of $545,000. For a couple, it's $640,000. That is open to interpretation, but that's the guidelines we've been given. Now, superannuation balances at various ages. These numbers are provided by QSuper, a very big Queensland industry fund. So you can see in all of these slides at various ages, females have a much lower balance than males do. Ages 25 to 34, the gap is not so big, but it increases. And once you reach 65 to 74 retirement age, there is a significant gap between males and females. So that's food for thought as well, and something we can do a little bit about, but certainly that gap is still there. Okay, so what we have here is a typical super statement. Typical in most respects, but probably not typical in the amount that this client has in super. So this gentleman has his superannuation with Russell Investments. This is a retail fund. So the difference between retail funds and industry funds is largely that a retail fund exists to provide a profit for that organisation, whereas industry funds have been set up for their members, originally union members. And the obvious and big difference seems to be in the aspect of fees. So we'll have a look at that with this statement. Okay, so this person has pretty close to 800,000 in super. This gentleman is getting close to 60. So that's above the normal amount of super, but that doesn't really matter in terms of what we're showing you here. So this super statement shows his balance, but he's also got some amounts of insurance. So on death, the benefit would be, on top of his superannuation, an additional $220,000 for life and also TPD. And you can see there, he also has income protection of $9,312 per month, which is all well and good, but it bears thinking about the insurance that you do have in super, because generally speaking, it has a 2-year benefit period only. So it doesn't really cater for serious situations where somebody might be out of the workforce for an extended period of time. Ideally, income protection should take you all the way up to retirement. And we'll talk about that and the other parts of insurance in a session on its own in week 5. So that estimate there at age 67, that 787,000 would become 1.1 million, and the annual income above the lump sum is $64,000 a year. And because of the amount, obviously he doesn't qualify for the age pension. So this is what's happened. This statement is as at the 30th of June 2018. And as you can see, a year earlier, his balance was 711,000. His employer put in contributions at SGC at 9.5%, which was a bit more than $10,000. And the fund earned 71,000 during the year. Contributions tax applied, administration fees applied, and insurance premiums came out of that as well. So that took his balance to 780,000. So you're able to see the growth there. And the chart on the right will show you over the last 3 years, your super fund has done quite well without any additional contributions above the SGC. Bearing in mind 2018, to a lesser extent 2019, the performance of most super funds, this is in the balance space, most super funds has been quite good. Probably won't be the case during this year. So there's his concessional contributions at superannuation guarantee, $10,000. He didn't put any non-concessional contributions in. Concessional and non-contribution will be clarified in a later session, and the limits will explain what the limits are.
Pat, would you say that this was a typical superannuation fund balance for a lot of clients?
No, I wouldn't. This is on the high side. I don't often see, in the space that I work, I don't often see people who've got, close to 800,000 with another 8 or 9 or 10 years to go to retirement. I chose this one because it's a pretty good layout, and this super statement does cover a lot of issues. They don't all have the same amount of information in it. But most people have much less than this, for sure. So this gentleman's investments, he's in the balance space. Typically, a balanced investor will have about 60% in Australian and international shares, and that is the case here. He's got a relatively high amount of fixed income, so that's a conservative, obviously, space for him, and 4% in cash. So that's a fairly typical balanced portfolio. Okay, so this outlines the returns on each aspect of those investments. As you can see there, in the balance-based, 1 year's returns were 8.24, over 5 years averaged at 8.17, 10 years, or since inception, 7.03. So this gives you a breakup of the returns. If you want to see where the growth opportunities are, this gives you some sort of an idea. Cash returns very low, and 2019 even lower. So if something were to happen to our client here, his death benefit would be the balance of his super plus the life cover of 220,000. Same with TPD, and his income protection would kick in if necessary. Down the bottom, you can see beneficiaries. So he has nominated his spouse as his beneficiary. So it's pretty important to look at this. Week 7, we will touch on estate planning and the importance of beneficiaries and nominations for beneficiaries within super, also within insurance. Okay, this statement has quite a few pages of transactions, and if you're inclined to, you can have a good look at this. Probably the most important one here is the superannuation guarantee contribution. His employer has put in periodically $896.92. If you want to check that you are being paid the correct amount, superannuation guarantee rate is 9.5% of your gross salary. So you'll be able to do your calculations based on your payslip to make sure, because Colleen and I were talking about this earlier too, we've come across a lot of cases where people have been paid super amounts incorrectly, usually underpaid, sometimes not at all. So it's certainly worth checking, because it's an area where mistakes are rife. So that's it, $896.92. Contributions tax is 15 cents of the dollar going in, and then you can see the premiums for the insurance. Also, this particular super fund has a relatively high administration fee that's something we might talk about a little bit later too. Not all super funds, particularly the industry funds, have such a high administration fee, and I don't know really how they justify that.
The interesting thing here, Pat, is that the superannuation guarantee is only required to be paid by law unless they're under some award every 3 months, but his employer is actually putting it in each month.
Yes, and many employees put it in on a fortnightly basis as people get paid fortnightly, which helps the growth, the compounding growth of the super as well.
And also for businesses too, if they pay it monthly, it stops it building up, so there's not some huge sum to pay at the end of each quarter.
Yes.
Or even cash flow for a lot of businesses.
Good point. Okay, so here's a breakup. We will discuss this because it's so important in a separate session in week 3. The fees that come out of your super can really have an impact on the balance and your growth. So the indirect costs for this client for the year, $5,661. That's paid to the managers of the investments. That's the fee that they get. Invariably, that fee can range from 0.5 or 0.6 up to 2%. The retail funds, as I pointed to earlier, are generally a lot higher than the industry funds. So it is worth looking at that. And if you want to seek advice on whether you think that might be higher than you should be paying, we can talk to you about that. The administration fee, $2,275 for the year. Industry funds invariably are much, much lower than that. And really what is being administered, everything is computerized and seems to take care of itself. And there's the insurance premiums that have come out. So as Colleen pointed out to me earlier today, about $10,000 has come out, and that is effectively the contributions that his employer put in. So the 9.5% has been negated by the fees and insurance premiums. Fortunately, the funds showed a fair bit of growth during the year, so that was offset, but significant fees have been taken out of the investment.
Mm-hmm.
Usually there'll be a comment down the bottom. You can refer to the product disclosure statement in the investment guide from their provider, usually a document 30 or 40 pages long, and it dives into the fees, how they're charged, how they are applied, and what amounts are applied. So if you are inclined to do that, that's a good source of information for you.
Mm. And how many of our clients would actually read that product disclosure statement?
No, it's not very common. How many of our clients regularly read their superannuation statements? I think it's quite common amongst a lot of people just to file it away in the bottom drawer somewhere. But that's part of the discussion we will have and highlight how important it is to have a good look at it, because it's your money at the end of the day. And there's also the opportunity cost of not having things as they should be. Okay, so at the end of the statement, gives you a little bit more information on the assumptions that apply to the statement. It assumes investment earnings of 3% per year after inflation and investment fees. It assumes your wages will increase at the same rate of inflation. That's not the case for a lot of people at the moment. And they reserve the right to change that administration fee, of course, if they want to at some stage.
Okay, so for people who are watching this webinar either now or in the future when we put it up on the website, what we want to end each session with is an action plan for next week. So make sure you've got an online login for your super fund and log in and have a look at exactly what's happening with your fund. You can make sure that your employer's putting your money in, or if you're self-employed, make sure that your money's going in as you think it's going in. Make sure that you've got the level of cover that you've got in. It's actually really interesting to log in and just make sure everything's all right and do a regular review. And look at your mailed annual statement for the last 2 years, say, and just have a look at what your own situation is. And over the next 6 sessions, relate what we're talking about to what's happening on your superannuation statement. If you've got any questions, Pat's more than happy to talk to you on the phone or face to face and talk to you about your own particular situation. And hopefully you can take the steps that you need to improve the health of your super fund. But also, while you're looking at your own, if you've got a partner or working children, adult children who are working, talk to them about the health of your super fund and just make sure that they're set up okay. A couple of people that I've talked to in the last few weeks didn't really know what was happening with their fund, and their fund was taking insurance out of both of their funds and they hadn't consolidated it. And it came down to a really low balance, and people are relying on their superannuation to tide them over in retirement. I mean, that balance that Pat just showed you was chosen because it has a number of items that would apply to a number of people, but not a lot of people have got that balance. It's about getting people more aware of their super and what they can do to improve their balance and make sure that it's performing the way that we want it to for a comfortable retirement. So the next session is next Tuesday at 6 o'clock, and we'll be sending you out another invite to session 2, which is your own super. Is it a jigsaw puzzle? And if so, it's a jigsaw puzzle we'll be putting together hopefully for you in the next 6 weeks. So I really appreciate your time. Our contact details are up there, so contact either of us if you've got any questions or you want some follow-up, or there's something that you don't quite understand about what we said tonight, or something that you really, really want to have covered in the next 6 weeks that we could perhaps cover for you in one of the future sessions. So thanks again, everyone. We're finishing just before 6:30, and have a lovely night, and don't forget to contact us if you need to.